Today we will be talking about managerial accounting. We will start by contrasting managerial accounting with financial accounting. Financial accounting primarily seeks to provide useful information to external users, such as investors or creditors. Much of the useful information related to financial accounting is disclosed in an annual report. Examples include financial statements like the income statement, the balance sheet, the statement of retained earnings, and the statement of cash flows. Accounting policies such as depreciation and inventory costing methods. Information relating to pending lawsuits, and anything else deemed important for those external to the corporation. For financial accounting in America, publicly traded companies must adhere to generally accepted accounting principles, or GAAP, when reporting financial information. External auditing firms audit publicly traded corporations' financial reports to make sure they are compliant with GAAP. On the other hand, managerial accounting primarily seeks to provide useful information to internal users, such as employees or managers, hence the term managerial accounting. Much of the accounting information produced by managerial accountants relates to helping managers make important decisions on behalf of the company, such as determining the cost of the company's products or services, often called cost accounting, creating budgets and comparing the company's performance to the budgets, reports on the potential profitability of possible future projects. As managerial accounting information is not produced for external users, it's not subject to any framework of rules, like financial accounting and GAAP. Instead, companies determine what information they need to make planning and control decisions, and then they decide how that information is best collected and reported. Let's take some time to talk about different ways a company can classify their costs. First, we have either fixed or variable costs. Fixed costs do not change when the volume of an activity changes. For example, rent on the factory is a fixed cost with relation to the number of chairs a company produces in that factory. The cost of rent stays the same even when more chairs are produced. Variable costs do change when the volume of an activity changes. An example would be the cost of wood that is used to build the chair. Every additional chair produced will cost the company more in wood, so the material cost is a variable cost. If we were to draw a graph, fixed costs would be the same regardless of the number of chairs produced, whereas the variable costs associated with producing the chair would increase as more chairs were produced. Much of our focus in managerial accounting will be on determining the cost of producing a particular product. Companies that produce and sell their products are called manufacturers. The costs of a manufacturer can be broken down into product or period costs. Product costs are costs necessary for a manufacturer to create a product. These costs are included in the balance of a company's inventory account and expensed through cost of goods sold. There are three types of product costs. First, there are direct materials, abbreviated DM, which are the physical materials that go into creating the product, such as the wood used to build a chair. Next, we have direct labor, abbreviated DL, which is the cost of the employees who are directly responsible for converting materials into the finished product. This would include the wages of employees involved in the welding, painting, and forming of the chair. These first two product costs are considered direct costs because they are directly traceable to what we call a cost object, in this case, the chair. A cost object is just something that the company produces that they want to determine the cost of. The final type of product cost is called factory overhead, abbreviated FOH, which is defined as any additional manufacturing cost that is not direct material or direct labor. Factory overhead is an indirect cost as it cannot be traceable to a single cost object. For example, the salary of a supervisor who oversaw the work of both the production of tables and chairs would be classified as indirect labor. Their salary is associated with two different cost objects, both tables and chairs, and therefore is not directly related to one or the other. Their salary will have to somehow be split partially into the cost of making tables and partially into the cost of making chairs, which is the process we will discuss in future videos. Other examples of factory overhead include rent on a building where multiple products are made, or indirect materials that are not directly traceable to a single cost object. Product costs are often contrasted with period costs, which are non-production costs, which are more associated with a time period rather than with a completed product. Examples include selling expenses, such as advertising, and general and administrative expenses, such as office worker salaries. Period costs are expensed as incurred rather than being included as part of inventory and then expensed as cost of goods sold. Let's talk a little bit more about how we can further classify the three production costs of direct materials, direct labor, and factory overhead. Prime costs are the two direct production costs and include direct materials and direct labor. Conversion costs are expenditures incurred in the process of converting raw materials into finished goods and include factory overhead and direct labor. A helpful way to remember the differences between prime and conversion costs is through a Venn diagram. In the circle for conversion costs, we have factory overhead and direct labor. In the circle for prime costs, we have direct labor and direct materials. Notice that direct labor is both a prime and a conversion cost. The final topic I want to cover in this video are the three types of inventory for a manufacturer. There are three separate inventory accounts which are called raw materials inventory, work in process inventory, and finished goods inventory. Raw materials inventory are the unprocessed goods that a company uses in order to make products. They are the materials which, once fully processed, will become part of the finished product. Included are direct materials, such as the wood that would be used to create a chair, and indirect materials, such as glue that might be used in the production of the chair and other products, such as tables. The second type of inventory for a manufacturer is work in process inventory. This inventory consists of the products in the process of being manufactured but not yet complete, such as the back or the legs of a chair. The final type of inventory for a manufacturer is finished goods inventory. This consists of completed goods that are ready to be sold, such as a finished chair. We will talk more about how to calculate the balance of each of the three inventory accounts in future videos. That wraps up our introduction to managerial accounting. I know there was a lot of information presented in this video, but it will be worth your time to study what we have discussed, as it will be important as we move on to topics such as manufacturing statements, job order costing, and process costing in future videos.